And now it's time for On Point, where we speak to experts to delve deeper into key issues in the spotlight right now. Of course, the Federal Reserve last Wednesday raised its benchmark interest rate by half a percentage point in a bid to tame inflation. Now, the rate hike marked the biggest increase in 22 years.
And with the widely expected move, the Fed set its target federal funds rate to a range between 0.75% and 1%. But will this be enough to tame the ever-rising inflation, and how will this be reflected in the Bank of Korea's decisions? To find out, we connect with Oh Ji-yeol, Associate Professor at the Business School at Hanyang University in Seoul. Thank you very much for joining us this morning, Professor Oh. And, well, my first question to you really is that this rate hike was very much anticipated, but was it the right timing in your opinion?
First of all, pleasure to be on the program. I remember coming on this exact program a few months ago, and we were talking about, whether the Fed would increase rate by quarter percentage points 3 times, 4 times, 5 times back in November, December. But times have changed, and back then we were talking about inflation rising year on year by about 5 to 6%. And the latest data from March of 2022 shows that inflation just continues to be rising at a faster pace. It reached 8.5%, which is the highest rate for over 40 years, and not since 1981. So the Fed's more aggressive approach, though widely expected, is their, I wouldn't say belated, but their sort of response, much needed response towards taming all these inflationary expectations that seem to be fast running away.
So, Professor Oh, obviously for many, especially homeowners, having interest rates hike is going to be a big concern. But as long as it kind of tames the inflationary pressure, I'm sure everyone will be okay. But I guess with that being said, the big question is this enough to kind of ease the inflationary pressure that we've been seeing?
That's a question that remains to be seen. Jerome Powell and the Fed committee members initially thought this would be a transient thing. But then a lot has changed. We didn't anticipate Ukraine war. We didn't anticipate all these new variants continuing to exert the pace of reopening and all this inflationary pressure on wages and everything. So one thing that I would really look out for in the short term is that towards the end of this week, the April inflation numbers for the US will be released. There's a bit of disagreement here, but I would say the majority of the opinion are cautiously optimistic that inflation may have peaked, that on year, they're expecting it to be somewhere between 8 to 8.1%. So seeing some sign of inflation going down would obviously factor into how the Fed behaves over the next, say, 6 to 9 months. But as things stand, there's just a lot of uncertainties, especially with the war, with the fuel prices and everything. So all I can say for the moment is it really remains to be seen.
And with all this uncertainty, Professor Oh, how do you think the Fed's rate, its pace of rate hikes is really going to affect the Bank of Korea's decisions?
Right. So the inflation hasn't just been about the US. So we've just got the numbers for the April 2022 for Korean CPI. So Korea's CPI also rose by 4.8%, which is a lot faster than its 2% target. So Bank of Korea also has its own work to do as well. And, not responding to the Fed's interest rate moves has various repercussions on the exchange rate, for example. Over the past couple of months, exchange rate the won has been weakening significantly against the dollar. So that puts the Bank of Korea in a precarious position. And I think that at least this FOMC meeting was widely expected and factored in, so it will likely continue its own course of rate hikes. But I expect the Bank of Korea to continue on with monetary tightening throughout the year.
So, going back here in the country once again, like you said, if the BOK is widely expected to continue to increase its rate hikes, obviously it's going to ease the inflations a bit. But on the flip side, we still have to look at the economic impacts, the negative impacts that it is going to cause. So what would be some of them that I guess everyday citizens will face because of all this?
Well, I mean, we have the most important thing here is that we have become so accustomed to cheap money over the past decade or so. People have been building up debt either against their house or their credit, and been investing. And Nasdaq for the past week or so have been doing quite badly. So there will be various repercussions on the asset market side as well. But the one thing that I'm mostly worried about is obviously the housing market. Because of the house prices that have been skyrocketing over the past few years, people have been building a lot of debt against it and then buying houses. The interest rates on those loans are expected to increase substantially. And it's not out of the question we'll be seeing 6-7% for even like prime housing loans by the end of the year. So people that that contracted into these loans at 2-3%, they're going to have a hard time adjusting, and household consumption, consequently, will likely suffer sadly as a result.
Thank you very much, Professor Oh Ji-yeol of Hanyang University, for joining us this morning.
Thank you.